Okay, it's 7:30, so let's start. Thank you very much for joining me again for one of our updates, the fourth update on COVID-19 and the financial markets. Before I continue, just let me go through some housekeeping. Okay, please remember to mute your microphones and ensure that your webcam is off. We've had one or two incidents where the webcam was left open and everybody could see what you were doing. So anyway, during the Q&A, if you notice that there is a chat box, I think probably somewhere on your PC on the right-hand side maybe, you'll be using that to post questions, and I will be answering your questions based on whatever I see on the chat box itself. Okay. As usual, the disclaimer is all of this is basically for education purpose. If you really want advice, you should actually seek the advice of your financial advisor. Any figures that you see here are basically, past returns are not indication of future returns and the usual. Okay. Okay. Let's start the presentation proper now. Okay. Let's start by just updating our view on the markets. This, as I mentioned, this is the fourth update. For those of you who have just joined us for the very first time, the first three updates, we were actually trying to let our clients know basically what was our view, how our views were formulated, why we thought, for example, the COVID-19 scenario, as bad as it was, would probably be discounted, why markets are likely to bottom temporarily, so on and so forth. So I won't have time to go through all of that. We do have the recordings of all our previous updates. So I would actually request, or rather, if you would like to, make a request to your consultant, and he or she will be able to provide you with the initial first three updates. And I think when you piece them together, you have an idea of where we're coming from. Yeah, because it's very difficult for me to repeat everything for people who are new to the update series. Okay. But anyway, this was a key one. Mainly, we had actually way back when the this is the S&P 500. When the S&P 500 was 3024, we actually started with this chart, and this was the exact chart that we showed back then. We were saying that basically there would probably be roughly about 5 stages before we kind of reach a bottom. First stage was basically the markets underestimating COVID-19, thinking it's more like SARS, but actually turns out it's worse in terms of its infection rate. Then the authorities come in to actually intervene very heavily, fiscal, monetary, FOMC cut, so on and so forth. Then the market actually staged a rebound. But however, we believe that the market has continued to underestimate. Give me a second. I'm just going to get rid of my WhatsApp on my. Hang on. Okay, sorry. Basically, we continue to market continue to underestimate what we call the impact from COVID-19. And true enough, market has come down, and then but they will reach a point where market would bottom temporarily until because of what we call more good news coming in, fiscal packages, so on and so forth. But at the end of the day, we think that whatever the consequences from COVID-19, really it's just too massive. There will be what we call a domino effect, and causing what we call potentially even a further downturn. So the updated chart for this is this. Markets really went down after our session at, I think, about 2 sessions ago. Market has then started to bottom. This is really a bottoming part here, you see? This is a bottoming part here, okay? We haven't gone really into a stage 5 yet. So this is where there are some debate over whether this is actually going to be a V-shaped recovery or a further downturn, and we'll discuss that in a while's time. Okay, but this is to update you on where the markets are vis-a-vis what our so-called projection was, a week, 2, 3, 4 weeks ago. Okay. Okay. I'm just going to bring up this chart. This chart was brought up the last time. Okay, the last time it was brought up, basically, it was here, March 26. We were here. That's where we were arguing that the rebound itself in markets could actually move higher. As it turned out, and we drew this red line. this red line here without, of course, the real actual numbers back then. And of course, and if you look at the market today and you add in the real actual numbers, it actually went up according to what we expected. It actually peaked out at 2630. We were saying something like 2660 and 2800 was going to be more or less the resistant region, and then now it started to come down. Okay, what this really means is that if we are right, this is probably going to be the consolidation region for the time being. So it could be that the market could actually bounce between these two levels, which is i.e. 2192, which was set on March 23rd, and 2630, which was the recent high. And so we won't be surprised if the market keeps kind of like a W-shaped consolidation within this region temporarily until it decides whether it wants to go up or actually move one leg more down. Okay. So why this period is actually quite important for investors, and I'll tell you why. Because the sharp fall that we saw here was so sharp that very few people actually managed to react and do whatever they wanted to do, whether to get out or so on and so forth. So basically, this is really the first chance that investors have to take a breather and say that, okay, now let's see what I should be doing. Because really, it was quite impossible to do so over the past month as the markets really fell like a rock. So at this particular point, it's either one or two paths that you will take. The first path that you will take is you will say that it's going to be business as usual. After a short period of time, we're just going to resume this rally. Or it could be business unusual, which means that actually there's more downside to go. At this point, I would peg a 30% chance, and this is my own view, a 30% chance of business as usual and a 70% chance of business unusual. And over the next couple of slides, I want to share with you what are the strategies as an investor, because like I said, this is really a window of opportunity. It's not wrong to say that it could be business as usual. You could be right. Anybody out there who thinks that way. Okay, but at the same time, I think we just want to go through the strategies that one can adopt to see what actually is the best strategy that will suit various types of investors. Okay, why I wrote down depth and time, basically because the strategy that you adopt is basically not just dependent on how deep the market falls, but also how prolonged it is. Means to say that, you know, is it a V-shape, very sharp down and up? Or is it a down and then it prolongs for at least a couple of months, maybe a couple of years? So these two parameters work together to actually determine which kind of strategy you should adopt. Okay. So I've been hearing a lot of people say buy the dip. You know, a lot of I don't know, relationship managers, even people on CNBC, it's a good time to buy the dip and so on and so forth. There's nothing wrong with that kind of strategy to buy the dip. Okay, although we don't adhere to that view, but just let me explain. If you think that you want to buy the dip, I think it's fine. Really, that's your choice. But caveat emptor, buyer beware. You would be actually timing the market. You'll be saying to yourself, I'm buying the dip. And here, when I say buy the dip, it's actually taking 100% of what you want to invest and going in 100%. Okay, you are actually taking a bet that the market is a V-shaped recovery. Okay, because otherwise, you know, why would you want to buy now? You know, if you think that the market is going to go sideways, or if you think the market is going to go down, you probably want to just hang on for a little while. But if you're going in 100% at this particular point, means you are, you know, for lack of a better word, gung-ho enough to think that this is roughly near the bottom. Okay, so that would be the only reason why you would buy the dip. And I put these two axes here because if you really are someone who wants to buy the dip, from a technical perspective, if the market is truly ranging here, you probably would be either buying one when the market retreats back to the lower end of the range, or two, when the market actually breaks out from the range. There's nothing to stop you from buying in between and so on and so forth. I'm just telling you what a technical perspective is. If you're basing it on technical analysis, typically people will either buy here, which is just above the support level, a strong support level, or on the break of a very strong resistance level. Yeah, so basically these are the two technical levels that you would actually buy if you wanted to buy it. Just a little bit of recommendation if you are this type of investor. Okay, but buying the dip itself is, like I mentioned earlier, an element of market timing. So basically the risk of buying the dip is if you buy here and the market continues to go lower, you may be hanging on to this baby for quite some time, because you would then need to wait for prices to come back above your buying level before you start making money. And that's assuming that you can hang on throughout this whole ride. Not many people can do so. Okay, so basically that's the main danger of buying the dip. You are basically putting a bet that you've got it right. The market may not go down so much. You can just tahan for a little while. But if the market does go down for an extended period, then you're in for quite a terrible ride. Okay, so this is really the risk of buying the dip. What we would actually advise is actually to do what we call dollar cost averaging. If you have $100,000, you have 100% of that, you probably break it up into maybe 10%, 10%, 10%, 10%, 10%. You could do that. You could probably break it up into 5. This is called dollar cost averaging. You probably could go in every month. You probably could go in every other month. So dollar cost averaging is just basically breaking up your investment into several parts over an extended period. The period could be a short period, could be a long period. It really depends. Yeah. So let's look at dollar cost averaging and how I feel investors. This is a better strategy for investors if you're going in around this time. Okay. If this is really going to be first let's get this out of the way first. I don't think we're going to see a V-shaped recovery. No, I don't think anybody is talking about that anymore. Everybody realizes that this crisis is just too immense for there to be a 2008, 2009 down and up. So we're not going to like come down. We've come down all the way here, and we're not going to just go up all the way straight and resume whatever we were doing, business as usual. I don't think anybody is looking at that. Okay, so I think I'll rule that out. Okay, but we could potentially see what we call a U shape here, like this, or a W shape. And I think a W shape is more likely in my view. Okay, but I call this a short time frame. Why do I call this a short time frame? Again, this is again the first view, that is the markets will business as usual. A short time frame means the market will consolidate mainly maybe about 3 months, 4 months, 5 months, maybe 6 months, and then it will resume business as usual. Okay, so this is basically the first view where we have kind of like a decline, a short period of consolidation, and then a move higher. If you do a 10-month dollar cost averaging, for example, you would actually be buying the majority of your installments. I'll just call it installments for the lack of a better word. You'll be putting in most of your installments at the front end here, and then after that, you may catch some of the up move, but your average will still roughly be around here. You will never get the bottom with dollar cost averaging, unlike market timing, but you'll get a relatively nice average. So when the market actually moves higher, you are, as in totality, your buying price on average will be the red line here, whereas the market would have gone higher. So you will be profiting from there on. Okay, so a good strategy if you think that it's going to be a short-term consolidation, short-term crisis, we're going to get out of it over the next 6 to 12 months, for example. Okay. If the market doesn't go your way, and the market declines, so that means it becomes a very deep one more leg down. Okay. So this is actually what we could also call business unusual. Okay, but it still is what we call a relatively short time frame. Let's say next 10 months, or less than 10 months, or less than 12 months. So the next 12 months, the market continues to decline. Market finds a bottom roughly, let's say, in the middle of next year, okay, or even first quarter or first half of next year, okay, and then market starts to rally. So what will happen is your 10 or 12 installments would be in on the way down, and maybe a good number of them would be at near the bottom of the market, which is excellent. Okay, I mean, that's assuming we get it right, but the average price would be something like this. So it's still a good strategy if you adopt a 10-month, 12-month dollar cost averaging. You would still probably be catching the downturn, assuming that the downturn lasts for about 12 months. Okay. What if it's just a mid in between what we call the first scenario and just now the second scenario? Same thing. You'll probably be catching it on the way down and somewhere around here, and then your average will be here. So what I'm trying to say is, when we deal with a short time frame, if your view is that this thing is going to last maybe 6 months, you know, market's going to rally after that, market's going to rally after 12 months or after 9 months, then a 10-month dollar cost averaging would be your best strategy. You'd be actually averaging really quite near to the bottom, because the bottom is anywhere between now and the next 12 months. Okay, so it's really a good strategy if you have that type of view. Well, where dollar cost averaging fails is if the downturn is extended. If we get something like the year 2000 to 2003, what will happen is in the year 2000, of course, we know that the dot-com bubble burst. That led to the slew of corporate scandals, Enron, WorldCom, and so on and so forth, Arthur Andersen, so on and so forth. Okay, then came the terrorist attacks, and then after that, SARS. We had SARS back then. Okay, right now we have COVID right in front, but we had SARS almost towards the end, and then we had the invasion of Iraq in 2003. If you look at the dates, this whole crisis lasted 3 years. It wasn't 1 year, it wasn't 12 months, it was actually roughly about 3 years. Okay, in this particular case, if we adopt a 10-month dollar cost averaging now between 2020 to say mid 2021, your average price, despite the fact that you're not going lump sum, your average price will be here. Because why? Because the market actually drops for 3 years. So basically, that's the risk of dollar cost averaging, is if the market actually prolongs longer than what we call 1 year, it goes into a second year, it goes into a third year. So a 2000 to 2003 scenario. It's excellent if it's it's a 2008, 2009 scenario, excellent because sharp. Okay, but if it's 2000 to 2003, then there's some problem here. Okay, what is the solution? Well, the solution, there are two solutions. Solution number one is, instead of doing 10 months, you could actually do what we call 20 months. You prolong it. I know basically 20 months means 5%, 5%, 5%. It looks really boring and stuff to put in 5% every single month. But you could actually do this. You could start off with 5, 5, 5. The market starts coming down. If market really starts to bottom out and turn up earlier, then you can always change your strategy. Instead of sticking to the 5, you can then start going in 10, or you can start putting in 20 if you're more confident, and then so on and so forth. Okay, it's just that you don't want to be heavy as it goes down lower from the top here, because there's still a long journey down. You don't want to expand your ammunition too fast. Okay, so this is probably one good strategy that you can adopt. Another strategy that you could adopt is basically what we call a 10-month, sorry, not 10-month, still a 10-month DCA, but a lagging DCA. Means to say that you don't actually go in now, you actually go in later. Okay, so means to say you allow the market to drop a little bit, and then after that, when you feel comfortable, the market has sufficiently dropped, then you start going in. This has a little bit of market timing element. But this also plays into our view that basically market potentially has another leg down. Okay, so this one is what we could actually do as part of the solution if this decline is not just a 12-month decline, but a 24, 36 months decline. Okay. Okay, so basically, in a nutshell, in terms of our preference, okay, because right now, and I'll go through some of the reasons why. There is potentially a risk, and that's why I attribute a 70% chance of us going even deeper than where we are. That means this bottom that we are seeing today is just a temporary bottom. We could go lower. Okay, because of that, you adopting a 20-month dollar cost averaging would actually make sense to me. Okay, and like I said, you can always change course if proven wrong. Meaning to say that if we are proven wrong and the market starts to turn up, then you can always deploy much faster your remaining balance ammunition rather than keep it at 5% every month. Okay, so it's very flexible. In this particular case, as the market declines, what one should actually do is try and de-risk your existing portfolio. Move into bonds, move into what we call non-market correlated investments. It's more of trying to stabilize, de-risk your portfolio until we reach a point where we think that, okay, now it's time to re-risk your portfolio, and then we start deploying. Sell the bonds, put into equity. Sell the bonds, put into equity. Sell the non-market correlated investments, put into equity. Okay, at a later time. Okay, so that could be another strategy. And over the next couple of slides, I really want to focus on the bond side, because we've had a lot of questions from Singapore and also from our clients in Malaysia, who were scratching their heads in terms of, the bond market has actually declined in line with equity. So it's really, there's a sense of fear, because when you see your bonds decline, you always thought that they were the safe haven compared to equities, relative to equity. So it causes you to like, oh my, should I be selling my bonds also? Okay. In our view, no, you shouldn't be selling your bonds. You ought to be looking a bit more closely at what you're holding and trying to say to yourself, is this really the part of the bond market I want to be, or should I be on the safer side of the bond market? And I'll explain a little bit more what I mean by that. Okay. So basically, just a little bit on why I think we are not at the bottom yet. We could actually go for another leg down. I have to reiterate again, there's a 30% chance I may be wrong, 70% chance I think that it's going to go down further. But again, we always have views, and we will always change the views as and when we believe so. Okay. For those of you who have followed what we call my wealth forum before, I've always highlighted some of the dominoes that lie in front of us, and therefore I fear that these dominoes are beginning to fall. Okay, there is one particular domino which I want to bring to everybody's attention, which I think the market increasingly is looking at. Okay, so let me have a look at that. What I call it is the 2Ds crisis. Okay, let me explain a little bit. Okay. Some of you may have seen this chart. This chart is basically a chart of what we call GDP, gross domestic product, which is actually, we can always term it as the fundamentals of the economy, fundamental pricing of the economy, value of the economy. The blue line is basically household wealth in terms of bonds, equities, property, so on and so forth, the wealth of a household. Not surprisingly, the wealth of a household deviates away from what we call the economic fundamentals of an economy, very much in the same way whereby you value a house at 500,000, okay? The valuer comes to your house, values it at 500,000, but thereafter someone's willing to pay you 900,000. So basically, that 900,000 is 400,000 above your true value, okay? A premium. So this blue line here shows the premium. Basically, what happens is the value of all the assets tend to move far away from the fundamentals, but then a crisis comes along and pushes it back down to what we call fundamental levels. The only problem is in this last 10 years, because of low interest rates, because of huge amount of liquidity, there has been a lot of leveraging. There has been a lot of buying of assets using leverage and so on and so forth, both in terms of equities, both in terms of bonds, and also many other assets, that the value of assets today are so much more higher than what we deem to be the fundamental value. And now what I believe is, judging from what we've seen so far, there is a high risk that the crisis that we're seeing today could be a deleveraging coupled with a debt crisis. A deleveraging crisis is because so many people are leveraged up in terms of investing. And it could be things like borrowing money to invest in bonds, borrowing money to invest in equities, and so on and so forth. Even properties are a leveraging instrument. Okay, so there will be a deleveraging where people are going to sell this because they cannot meet margin calls. The value of their properties have declined. The banks are going after them. They have to force sell whatever assets they hold on leverage and so on and so forth. So that's the deleveraging part. And the debt side is basically because a lot of companies will probably go bankrupt. A lot of individuals will probably go bankrupt. Some countries will go bankrupt because, again, we have companies, countries, individuals that have lasted very long over the past 10 years, not because they were profitable, but because cash flow was moving. And we all know what's happening to cash flow nowadays. Okay, so we could be in a double D crisis, a deleveraging and a debt crisis, or you could even call it an insolvency crisis. Okay, and that's why you see worldwide all the governments coming out, and what are they trying to do? They are trying to provide a breather so that people, individuals, have the ability to shore up their cash flow. okay? Because that's the main thing. We see, for example, banks being asked, don't pay dividends, so that you can amass cash flow. We are seeing people, property owners being asked, don't give some relief on rentals to companies and corporations. Yeah, so a lot of things with regards to cash flow. Yeah, but I think here you understand what I'm trying to say. There is this risk that this crisis that is boiling up is not just solved by a 3-month decline in your asset prices. It will probably be longer than that. Okay. Mind you, even before COVID-19, there were already cracks in the markets because the market was just really hugely over-leveraged. I just show you here China. Of course, China has been a really over-leveraged economy and market for the past couple of years. So even before COVID-19, there were already signs of increasing defaults in China. Across the world itself, especially in the US, you see these kind of headlines, and these headlines were even before COVID-19. Corporate debt bubble, swelling US corporate debt is the next subprime. So the situation was bad enough. It's just that the bubble wasn't pricked and didn't burst. But I think what COVID-19 now risks is that it has actually burst that bubble. So we could actually see the consequences of it over the next couple of months. And that's the key worry. And that's why I think market could potentially move another leg lower. Okay. So basically, when you look at the headlines, you will realize that actually, or rather, when you read into the stories, you realize that it's actually not the junk market that we're worried about. For those of you who don't know, this is actually a ratings ladder showing you the various ratings of potentially a company or a country, or So basically, it starts with the highest rating all the way down to the lowest rating. In between here, there's something called the last level of investment grade rating is BBB. When you lose that 1B and become BB, whether it's BB plus, BB neutral, BB minus, you actually fall into what we call non-investment junk grade ratings. Okay, a junk grade bond. Okay, what has happened over the past couple of years is we've seen a humongous amount of BBBs being issued in the US and in many parts of the world. So these are companies who are not the really good quality companies, but these are companies which are okay, they're investment grade, but the fact of the matter is people, because of huge liquidity, I have borrowed from the bank at 1%. If I can put it in a BBB at 6% or 5%, wow, I'm making a spread of 4-5%, free money. So a lot of people were doing that. They were borrowing from the bank at very low rates, turning around and looking for these BBBs. Why not the AAAs? Because AAAs have much more lower interest rates. AAAs basically interest rates are 2-3%, so you can't make a huge spread. So you go for investment grade, but you go down all the way to the BBB, so that the BBBs at about 4-5-6% gives you a nice cushion. Borrow at 1, and then you lend out the money to the BBB at 6 or 7, and then you make a spread of about 4-5%. Free money to many people. Okay. The problem now is with a crisis, with a recession, a lot of these BBBs will fall into what we call a junk grade. Okay. This is just some numbers in the US itself. The US BBB, and this blue color is all BBB. The US BBB market is about 4.5 trillion. The US junk bond market is about 2 trillion. The estimates last time before COVID-19 was in a recession, typically 10% of BBBs will lose their rating and go into junk status. So if you just base it on 4.5 trillion, 10% is 450 billion. If 450 billion BBBs in a recession move into the junk bond market, that's 25% of the junk bond market. So overnight, I won't say overnight, I mean over a period of time, the junk bond markets will be flooded with this new BBBs that have just lost their ratings and moved into the junk status. So two things here is, one, under normal recessions, 10% of the market in BBBs will default, or 10% of the bonds in BBBs will default. What happens is, in a very distressed market like today, what we see, there's no surprise. No one's going to be surprised if this figure is 15, 20. No one knows at this particular point in time, but it's definitely going to be more than a normal recession. So if it's 20, that means almost $1 trillion worth of bonds are going to move from BBB down here, and that's half the total junk bond market. Okay, and that's going to kill the junk bond market, because then again, once the junk bond market is flooded, you're going to have prices being pressured down and so on and so forth. Okay, so it's not going to be really a very good a situation when this happens. So this really is what we call a potential trigger for a type of crisis whereby there's a misallocation, dysfunctional kind of markets, because just too much coming in at the same time. Okay. Okay. The next couple of slides are basically a little bit Malaysian centric, because I've actually prepared I had a lot of questions from our Malaysian consultants, which came from our Malaysian clients with regards to the bond market's decline in Malaysia. But this bond market decline has been across the world. So I'm using this Malaysia example, but you can easily apply this to Singapore, and you can easily apply this to many parts of the world, because we're seeing the same thing happen. Okay. So in Malaysia, what happened was basically the over a year-to-date basis, what you happen to see is basically the equity markets fell and the bond markets fell. Okay, you can see from here that the bond markets fell basically 1% from on a year-to-date basis. Equity markets fell about 17%, of course, off their lows. But again, let's not get confused, because the bond market is not homogeneous. It's not just one type of bonds. It's many types of bonds, and I'll show you. But this is just an aggregate of everything. So just to show you, compared to equities, bonds are still a relatively safer asset class than equities. I mean, at any time, you would rather be down 1-2% than down 17, 18, 20%. Okay, that's number one. Okay, when in Malaysia itself, and I go to this website called fundsupermart.com.my. Okay, when I call up the different types of ratings, and this is just bonds. You can do that in Singapore, you can do that anywhere in the world. The different bond ratings, starting from safest to basically the most riskiest, and there's a 6, 7, 8, 9, 10, but they typically apply to equities. Okay, you will see that over a year to 1 month, sorry, or 1 month period to March 26. Okay, yeah, so this was a bit dated, but nonetheless, okay, the money market front end, very safe type of fixed deposit type of funds still held above water. Okay, and then as we move down to maybe the high grade, the A, AA, triple A's and stuff, it lost a little bit. And then as we move down lower, we move down lower, you see that this is the high yield, the junk grade, they lost a lot, which is, it makes sense, because as you go down the credit rating scale or risk rating, or you go up the risk rating scale, means you take on more risk, the bond is riskier, therefore it is more volatile. Okay, so this is just to show you that the bond market is not just one bond. You cannot say that just because it's a bond, it's not risky. No, because there are different types of bonds in the bond market. So you need to understand that. Okay, and I'll give you this table to further elaborate. We are today in a deleveraging environment, meaning to say that basically a lot of companies have borrowed, a lot of companies are over leveraged, a lot of companies may not be able to pay the bonds that they have issued. Okay, so that produces a problem, which is defaults. So basically there'll be a lot of it'll be a situation whereby we need to be very careful even when we invest in bond. So we have to be quite selective, and I'm going to try to tell you what to look out for from that respect. Okay, if you're talking about money markets, okay, which held up very good, I'm just going to, this is basically taken from a fact sheet of a particular money market fund, which I'm not going to tell you the name because I don't want to be advising you online like this. You need to talk to your advisor in order to get details of what these funds are. But similarly in Singapore, be able to find some such funds also. Okay, basically you'll find that money markets are safe because most of them are of high grade quality. Okay, you may find something called NR, which is non-rated. Don't be worried when you see something NR and it's a huge amount of NR. This basically just means that some money market instruments are not rated because the person issuing the money market decided that it's just going to be so short term. If I pay for ratings. Ratings are not free. You need to pay for ratings. It's just going to eat into the returns, and it's not going to be fair to the investor and so on and so forth. If I'm already so-called Telecom Malaysia, if I'm already a government-linked institution in Malaysia, people know me. I don't need to be rated for my short-term money market instruments. People can look at my long-term instruments and say that I'm a AAA, and then if I don't rate my short-term, they'll still look at me as this is as good as a AAA. So basically, this is non-rated. Okay, so they don't have to be worried too much, because mainly this non-rated also is of a high quality. Okay, so that's the safety of money market. When you go to high investment grades, then when you look into the fund fact sheet, okay, and this is an example of a high investment grade, then you'll find that majority are actually A's. It could be single A, it could be double A. Of course, triple A is the best. And the best, of course, when you see such words as government or government guaranteed. So this is, bonds which are government bonds. The government doesn't want to be rated, doesn't want to pay for rating because it's the government. Yeah, everybody rates the government as the most credit-worthy entity in the market, and also government guaranteed. And just to remind you, the reason why governments are considered to be risk-free rate, government rates are risk-free rate, because government can do two things no other entity in the country can do is, if it has problems paying its bonds, it will raise taxes. So it raises tax, gets the revenue, pays its existing bonds. So no other entity across the land can raise taxes except the government. Number two, government can always print money. Okay, by printing money, they can always pay off their, they print money by monetizing their bonds with the central bank. Whatever the case is, they can actually do that. So basically, governments. That's why when you study finance, government rates, interest rates, or bond rates are considered to be risk-free. This is why they're risk-free, because they can actually create money out of thin air to pay their bonds. Okay, so anyway, so when you look into a bond fund fact sheet and you come across something like this, this is good, because you have about 40% really in very high quality, and the rest are still very good in AAA, in double A and single A. Yeah? So this is something which you want to aim for. Yeah. And the triple B, which I mentioned, there's a little bit of dangers in the triple B, because as I mentioned earlier, the triple Bs could easily fall down to double B, which is, so if you're a fund and you're mandated to hold investment grade only, if you're holding to a triple B, which suddenly moves down to a double B, which is no longer investment grade, then you cannot hold on to that fund. You will need to dispose of that fund. Sorry, not fund, that particular bond. So you have to then sell that bond and use the money to look for a new investment grade, because you cannot be holding on to non-investment grade. So that's one of the dangers, because what you'll find is that if the prices for the junk double B is no good, fund manager may be forced to sell at a very low price, which will affect your bond, your unit trust, bond unit trust. Okay, so that's one thing. You have certain bond funds which are no rating constraint. They can go all the way from AAA all the way down to double B, triple C, junk status and stuff. They can go. This is an example of a global no rating constraint. If you go into the fact sheet, you'll find that it invests in triple A's, it also invests in triple B's, and also invests in junk status, double B and B itself. This, I'm not so keen in this kind of funds, because again, I'm worried about the triple B's and of course the default rates on even the junk status bonds. So yeah, but just to let you know, so that when you look at your fund or your advisor goes through with you, then you can find out which one you're comfortable with, you're not comfortable with. There are some funds which are highly concentrated. You just have to be careful with these funds. This fund, for example, if you look at it, it actually did very well. It only fell 1.7 compared to even what we call the high grade bonds. The reason was it was invested in it just concentrated in two particular funds. Okay, so while that acted in favor of the fund, because these two funds, or these two bonds held up in value, when we are going into a deleveraging high default scenario environment, I would be a bit concerned when my fund, or let's say if I bought into this fund, it would actually be just concentrated into two bonds. One goes belly up, I'm dead. So again, this kind of things you need to really look out for. Okay. So some of you may ask, Sani, if if how come a triple A, let's not talk about even triple Bs. Okay, let's talk about triple A or double A fund. How come double A fund can also go down by about 2%? Well, the answer to that is even as good a grade as a bond is, there are periods in time where temporarily you get sell-offs, especially when the market is in a dysfunctional mode. And dysfunctional means where people sometimes are just so fearful, they don't come in to buy any bonds. And a lot of bond markets were frozen recently. We have clients who wanted to sell certain bonds, went into the market, and these are not funds, these are just individual bonds. And then the banker, their private bankers told them that actually no one's bidding for it. There's no bid. You can't sell, because no one's actually looking to buy your bond. So that's really a dysfunctional market. And that's where even sometimes good bonds, like a triple A, you want to sell, people sometimes, there are bids, but the bids are like much lower than what you would expect, and then that's causing what we call these kind of gap downs, even for a triple A to go down by 2% and so on. But this is just a temporary thing because it's technical in nature. Markets don't remain frozen indefinitely. They will remain for a temporary short period of time. You get a little bit of downside in your bonds, and then after that it recovers. Okay, so what you see now, a decline in your double A, triple A, it's just a technical thing. It's not structural in a sense. Okay. Other things to look out for: if you have bonds, you're holding on to bond funds, and your bond fund is actually a huge amount of cash. Okay. Has quite a lot of short-term maturity. When short-term maturity means the bond matures, you get back your capital. So the fund manager has more money to play around with to look for bargains and stuff. So that's good in this environment, because of dysfunctional markets, you get a lot of mispricing, and then the bond manager can actually pick up really good stuff on your behalf. So this is good. Okay. In terms of sector, I would actually be comfortable if my bond actually was more heavily in, for example, the banking sector. You may ask why, and of course the government sector with the government. You may ask why, but because the banks today compared to 2008, 2009, they are totally different. In 2008 and 2009, the banks, in terms of capitalization, in terms of being able to undertake stress, was so much more less, and that's why they got into trouble. After that, because of that, many central banks came out with many measures, including Basel II, Basel III, whatever you have, to shore up the banking capitalization overall, make them actually adhere to certain things. Banks are not allowed to trade. Banks now must focus on core activities. So all this has been happening over the past 10 years. So now today banks are in a less likely scenario to be the cause of the crisis. If you were to ask me, the cause of the crisis would actually be defaulting SMEs, defaulting some of the big companies which just over leverage themselves. So it'd be more of the normal real economy companies rather than the finance companies or the financial side. So if you're holding on to a banking bond, a bond related to a bank, then relatively speaking, to me, it's much safer. Okay, and we've had questions also. For example, what makes you so sure that if a bond price falls today, like a double A, that it will eventually go up again? Why, maybe it's like equities will go down all the way and not come up for a long, long time. Well, actually, you must understand that the bonds actually derive their returns from different things. Three things mainly. Okay. From one is capital movement, capital appreciation, depreciation. That's really a function of interest rates. We all heard the thing: as interest rates go up, bond prices come down. As interest rates go down, bond prices go up. Okay. Number two is the coupons that you receive from the bonds. That adds on to the capital. That adds on to the returns. And number three is the change in foreign exchange. If you're buying into a foreign bond, you're buying into a US dollar bond. Then if the US dollar against the ringgit changes, then your return on that bond is affected, whether positively or negatively. However, if you're buying a local Singapore bond and you're Singaporean, or if you're Malaysian, you're buying a local Malaysian bond, you don't have FX rate. So basically you just have to contend with those two other things: capital and coupon. Okay, so if a short-term hit a technical hit to a bond results in let's say a 2% decline in its value, okay, what happens is over the next couple of months, as long as the issuer doesn't go bankrupt, does the bondholder still continue to receive coupons? Yes, of course. He or she will continue to receive coupons every 6 months. So despite an initial, let's say, 2% decline due to a hit from a capital-related item, yeah, either interest rates have gone up, bond prices have gone down, or dysfunctional markets have caused bond prices to go down by 2%. As you receive your coupons over the next couple of months, you then make up for the losses of that 2%, eventually going back to zero at the end of the day. And that's why I mentioned earlier, bonds, good bonds, okay, they will go up, they sometimes get hit because of technical reasons, and then they recover back again. Okay, if you just look at this table which I provided here, and this was provided by one of the fund managers with respect to what we call interest rate sensitivity of a bond. For example, if interest rates today suddenly spiked up in Malaysia by 75 basis points, which is 0.75%, that portfolio held by the fund manager would drop by 3.4%. I mean, that's absolutely true because interest rates up, bond prices come down. Okay. However, ceteris paribus means to say that everything else remaining constant, as the coupons are received and interest rates don't go down anymore, don't go up anymore, as coupons are received, you'll find that actually the bond actually recovers, and despite the initial hit, after 1 year, 360 days, it will actually go to 0.7%. That means it will make back whatever it has lost and even make a little bit more. Okay, so this is one reason why the bond market is still a safe place to be, despite some of these dysfunctional things going on, because eventually it does pick up the losses that is made. It's just that you must be very careful to be in what we call high quality bonds, not the ones that are of a lower quality. Okay. So please don't be frightened when you look at charts like this. This is a bond market chart of one particular bond, which fell like this. So when you look at the chart, you're really scared. But when you look really at the numbers, it's just roughly about a 4% decline in a very short period of time, nonetheless. Okay. But if you had held the bond for basically throughout the year to date, from January, you held it. Basically, from January until now, it's just down about 1%. It's just that this 4% decline was quite steep, so people were scared. But this is what I'm telling you. This same bond, when you look at it over a 10-year period, there are instances where it does come down. It comes down because maybe of technical reasons and so on and so forth. Okay, but then eventually it makes back the losses that, as I mentioned prior to this in that table, why it does so and so and so forth. Yeah, so don't be too afraid when you see your bonds come down. It's just that you need to make sure what type of bond fund you have, whether this is the high quality, low quality, and so on and so forth. Okay. So in summary, you still can go and get some shelter in the bond segment of the asset classes, okay? Because we think that the present sell-off is basically technical rather than structural. Margin calls, people holding on to leverage bonds, which had made a lot of money in prior years. This leverage bond, let me explain a little bit. Basically, because bonds give you so low interest rates, you buy $1 million bond, it only gives you 2%. So what you do is you borrow from the bank another 2 million, 3 million, so that basically you're using other people's money. Now you're getting not only 2% interest, you're leveraging up to 6% interest, for example. You know, and last year when central banks reduced interest rates, then you not only made the coupons, but you made a good capital gain. We know of people who made 20-30% on bonds on this kind of leverage instruments. You have to be very careful because this is actually when the deleveraging occurs. Banks are going to come asking you for margin calls and so on and so forth. Okay, and this is what's affecting the bond market because these people need to sell and get rid of their bonds in order to pay for margin and so on and so forth. So basically, it's nothing wrong to do with the bond itself in a sense. If it's a good quality bond, it's just the market being dysfunctional temporarily. Focus on quality. I mentioned this is really a deleveraging environment. You do not want to be, whether it's bonds or equities, even if you're in equities, you do not want to be in the really vulnerable equities, those that are highly leveraged, those that have a lot of borrowings, those that do not have very good cash flows. Those kind of equities would be actually something which is a bit dangerous in this kind of environment. Okay. We still prefer the short end of the bond market, meaning to say that the money market, short duration. Yes, I understand that being in the long end is quite lucrative. Even if I buy a government bond, a long end government bond, basically what will happen is as interest rates go down, my long end government bonds will make much more money than my short end because of what we call something called duration. Okay, I don't mind taking a little bit of that kind of risk, but not too much. Again, in this kind of really unsettling environment where dysfunctional markets are everywhere, I prefer to stay. The majority of funds will be in the front end. Okay, you need a diversified portfolio, meaning to say that if I were given a chance to own a high quality bond, a single bond versus a high quality portfolio, 4 or 5 or 10 good bonds, I would definitely go for this, the diversified one, because we really don't know in this environment how even a single bond itself will react. You may be so unlucky to be holding on to a AAA, and it's the only AAA that actually defaults in the crisis. And there are certain defaults in AAAs during crisis, because not all AAAs can sustain sometimes whatever it is. Yeah, so there could be a small default even in AAA. So you play safe, go into a diversified portfolio of many AAAs, many double A's, and so on. Okay, we think that in order to take one headache out of the equation, we prefer to stay local. It's playing the currency game by using a bond is actually, again, at this particular point, a bit of a headache. The US dollar has strengthened, it's probably going to weaken, but how's the ringgit Sing going to react? How's the ringgit Aussie going to react? How's the ringgit Euro going to react? Sing Euro, So really, markets are so uncertain at this point. I would prefer to play safe, and therefore, if it's a Singapore investor, go for Singapore local denominated bonds, front end, high grade. Malaysian investor, Malaysian denominated, ringgit denominated bonds, front end, high grade. With a little bit of long end, fine, but must be high grade. Yeah, so this kind of situation. Okay, again, we have this YouTube channel. I'm going to update it with some of the latest ones, especially on this Malaysian bond thing. I think I want to update that. But do subscribe to our channel. We'll be updating a bit more videos over the next couple of days. Now Singapore has announced only just now that we are not in like Malaysia in total full lockdown, but everybody probably has to work from home. Yeah, so you'll find a lot more updates because from home. Also, if you need to, do request for the previous updates, videos on updates that we had, okay, with respect to the markets. Okay, we've reached the Q&A segment today. I hope it has been useful to you. Like I mentioned, a lot of the views on the markets were actually already in update 1, update 2, update 3. So this update, because I think we've been given this opportunity, if you're in the markets have stabilized a bit, you really need to now think, what should I do? What should I do? And that's why I focus a little bit more on the strategies that you should take in this lull period, before the next wave come, whether it's going up or going down. And I've tried to make the case that bonds are still okay, because we find some clients and some investors, because they got scared because the bond market fell, so they did not only go and sell all their equities, they sell all their bonds and they sit aside, which is, in my view, a bit sad, in the sense that you do know that when you sell everything and move out the market, and you tell yourself, I'll come back in again when the opportunity arises. I've been in the market for so long. I've gone through the 97 crisis, I've gone through the .com crisis, I've gone through the 08 crisis, and I can tell you, investors who come out from the markets, especially with a loss, psychologically it's very difficult for them to come back into the market, despite them saying, I will do so when the time is right. They will only come back when they start seeing other people, their colleagues making money, their family members making money, and people telling them how easy. Then the confidence actually starts to come back, and by the time they themselves return to the market, it's probably at the last stage of the market, which is the wrong time to come in. The way to be in the market, when you're in the market, you're more engaged. you're more in tune with the markets. So basically you're managing your risk now, looking for opportunities. When you're out of the market, basically you lose touch with the market. So we don't encourage people to get out totally from the market. We encourage them to lower down the risk, wait for opportunities. Okay, we're going to open it up for Q&A. Sorry, for Q&A. I think I saw some questions there. What is meant to buy bonds with more front end? Okay, so basically the yield curve, basically when people talk about a yield curve, it means short-term bonds. Short-term bonds are basically 1 year and below, medium-term bonds, and then bonds with 30 years, 20, 30 years. So the front end is basically short-term. It could be, so when you look into a bond unit trust segment, it will fall under 2 categories. Either you find it under money market bonds, or you find it under what we call short-term bonds. Some of the funds will call XYZ short-term bonds, XYZ money market bonds. So those are actually the front-end type of bonds, which are less volatile, much more safer. Okay. For those investors who have positions in defensive portfolios or high allocation in safe haven investments like gold, what's your suggestion moving forward, especially you have the view 70% odds on second down leg? So if you're already defensive, basically now it's just basically trying to extract 2 things. Basically, one is to protect your capital. Okay, make sure that this is a portfolio which either can withstand a second down leg, and also even if it drops a little bit, no worries. I mean, you know, you can't be, sometimes we can't actually have a perfect portfolio, which actually we don't have in our world. The myriad of instruments that they have in the US. In the US, they have things like short ETFs and stuff like that, where you can plug in, and then after that, you just protect your portfolio because you can perfectly hedge your portfolio. Yeah, in the absence of that, even if your portfolio drops a little bit, I'm not too worried. Just have it defensive. If you can extract some returns, even in the falling markets, by investing in what we call non-market correlated investments, then even better. You put 10, 20%. What will happen is, as the market declines, your portfolio either doesn't lose money or lose a little bit of money, but your non-market side makes up more than makes up for it. So basically, it's a strategy of keeping your capital, your gunpowder dry, while making some returns, being in tune with the markets. When the opportunity arises, then you redeploy risk. So that would be my strategy for someone who is defensive, and we are defensive for that matter, and that's what we intend to do. But again, like I mentioned, you could actually start to even dollar cost average in the market. There's nothing wrong with that. So you could be defensive, but you may say that, you know, Sani, maybe I'm a little bit more bullish than you, so maybe I want to start now deploying. But I understand your idea. I'll deploy 5%, or every 2 months I'll deploy 10%, and if there's a need to change it, I'll change it. So you could do that. You know, I think most important thing is having a plan. The worst thing that can happen today is you don't plan this opportunity that's been given to you by the market, this lull period. If you just sit back and you hope that markets will recover and you don't have a plan, that's dangerous, because as the market falls, your mind, your emotional self-being is going to be affected. You're like, oh, what am I going to do? I better hang on for a little while, and you find that you're going to sell at the worst possible time. Okay. Beside bond funds, what's your view on REIT funds, especially Singapore and Malaysian REIT, for moderately aggressive investor? Okay, we think that REITs are one of the instruments which you ought to pick up when, of course, you know, REITs is basically distribution, okay, over price. That's where you get your distribution yield, your rental yield, so to say. Okay, so as your REITs price go down and your distribution comes in, and even if distribution drops a little bit, you find that some of your REITs and even some of your dividend yields on certain stocks, they are going to like double digits, 10, 15%, and so on and so forth. Okay, but I think there's a timing element to that. Why am I saying that? It's because really this crisis is not the same as other crises. You have, for example, for the REITs market, a big question mark now in terms of selection. Do you choose REITs which are, for example, office REITs, which today, because of what's happening, of course, all rentals are down. Some people will go bust within your building, so they can't pay, so therefore your collection is less. But after that, what happens? Maybe tenants will start saying, you know, I don't need to rent the whole floor. Maybe I'll just rent half of it. You know why? Because I set up all the infrastructure for work from home. So basically, I want to save, because of the situation is so bad also. Now I need to save over the next couple of years some money. I'll just rent half of your floors and stuff like that. So that could happen. So really, a lot of these things are a bit uncertain today. So that's why I say it's a little bit of a timing game. While the concept of REITs is excellent, I personally think if we can pick out a few which we are confident that the rentals will not be hit, not only now but post COVID-19, then it's okay. Then it's fine. But if not, then it's a question of, let's try and have a lower expectation for rentals. And yet, when prices go down, then when you add these two things together, you get a distribution yield which is fairly attractive. Then you lock in. That is also a strategy. Okay, so you kind of discount the fact that rentals are coming down. Okay, but you also know that prices are coming down. So add those two together, you get good rental yield. You have incorporated the worst case. You lock in a 8-9% rental yield, and that's your rental yield for under a post-COVID environment. I mean, that's fine. So there's a bit of strategizing in terms of REITs, but nonetheless, I think it's a good instrument. Okay. Sorry, I'm just trying to figure out. Let me just get this first. There's a few questions. May I ask what is the REIT? Oh, the REIT outlook? I think I mentioned already. Yeah, so I kind of mentioned about the REITs. Sorry. So Joey, I hope I've answered your question also. Support resistance level for KLCI. Chan, I apologize. I've not looked at the KLCI market. I can look at it from a technical perspective, and I can give it to the consultant. So your name here is Chan. I'm not sure whether you're our consultant or client. Whoever you are, we will give it to the consultant, and your consultant will probably pass it on to you. Yeah, we can do a kind of just a support resistance for KLCI. I apologize, I don't have it now. What's your view of support resistance level? Same one. It's puzzling that market is still strong despite a spike in unemployment claims to 6.6 million, doubling that of previous week. Your comments, please. Oh yeah, I think in previous updates we've more or less argued, or I've more or less argued the case. Anything that's got to do with COVID-19 has been fully priced in by the market. You do not need to see the peak in cases. You do not need to see a decline in death rates. It's all been priced in. So nothing now that will come out in terms of news from COVID-19 will impact the market unless the virus mutates. Then that's a different story. Okay. Then on the economic side, a huge amount of what has been, or rather a huge amount of expected decline in macroeconomic figures has also been discounted, because the markets are smart. I'm an economist. I look at what happened to China. I see China's industrial production and retail sales go down through the bottom, not bottom, but through the floor in February, and then it's rebounded in March. So I know that the numbers in the US and many other numbers across the world in terms of production and stuff like that, which are more of a leading indicator, are just going to be terrible. So when you talk to me about employment, I've priced it because employment is a lagging indicator, for example. So most of the macroeconomic figures being pretty bad, to me, has been more or less discounted. Yeah. What the market hasn't discounted maybe is two things. Okay, one is the fact that post COVID-19, the world will be a different world. As long as we do not find a vaccine, and I would argue that a vaccine will only be found in the next 12 to 18 months, not like some people say 6 months or even less than that. Most reputable science journals, scientists and stuff, they would tell you that it's actually 12 to 18 months. Okay, until we find a vaccine, even when we pass this current peak in the COVID epidemic curve, things are not going to go back to normal. People are still going to adopt social distancing. People are still going to refrain themselves from flying. People are still going to, when you go to a restaurant, they're going to have seats far away from one another because of social distancing. They need to maintain that. So almost automatically, your revenues to that particular restaurant is halved because there's one missing seat everywhere you go. In your aeroplanes, they could be in your movie theaters. It could be you still have to have one seat distance between people seated together. So that's 50% of your revenue, and that's assuming everybody travels. But if I'm not infected, and I'm talking about myself today in this current wave, and without a vaccine, I'm going to be very careful even after this thing ends in the US. And I'm telling you, the thing in the US itself is going to end in the middle of the year. It's very clear when you look at the curve and everything. By July, maximum August, the death rates are going to go to negligible rates like what you see in China, in the double digits, 10, 15, 20, whatever the case is. Yeah? But the virus is still around. And that's why China today has this kind of reintroduction and stuff like that. So I would be extremely careful even after this period. And therefore, I will not spend a lot. I will not travel a lot. I will be very careful. So again, that part, I don't think the market has actually discounted. People are saying it's business as usual after this. I don't think so. I think that part would cause the market to actually decline, coupled with the defaults. Because so that ties to the economic side, but not so much of macro figures, but this is more of bankruptcies, default figures, companies. We really haven't seen, and we don't have a finger on the amount of defaults that's going to happen. All models don't work. I'm telling you, there's no model in the world today that can actually model what we are facing, because we've never faced a situation where the whole global economy or the whole world has ceased working. Cash flow has just gone to zero for many businesses. Many individuals are now facing problems. And that's why all these things about deferment in loans and stuff, you've never seen this before. So I could be wrong, the market could actually recover, but because of the uncertainty, I'm saying that the likelihood, I think, it's not going to be what the market expects. Okay. Sorry. If I would like to take advantage of the consolidation to do more short-term trading downwards, anything I need to watch out for? Colin, when you say short-term trading downwards, what do you mean by downwards? Okay. Of course, if you want to trade, if you're going to trade the range today as a trader, you would sell the top side and buy the bottom. Every time it goes down, you buy top side, you sell top bottom, buy top side. And then if you get caught, i.e. it breaks out from the range, you just cut your position. Okay, then you would have played the range, but then you relook again and see whether this thing now is trending or not. Okay, so yeah, so I'm just not trying to figure out what you mean by the downside itself. Okay. Has the market priced in potential credit default that may affect the financial system? This event may come earlier due to yes, I think it's a very good question, and this is what I'm alluding to. I think the credit defaults may be very high. I'm not sure, because I think that's one thing we call it systemic risk. There could be a default of a large institution, a large MNC, something which is tied to many other banks. You know, it causes one bank to a less well-capitalized bank, a smaller bank, whatever the case is. It could cause systemic risk within a sector. Yeah, so actually that's really something which we need to look out for, and that's the big question mark which is left hanging over my head, which puts me more in the camp of seeing markets go lower than higher, because I think there will be a default. I don't believe that there will not be a default, and I don't say this because I wish that there will be a default. I'm saying this because in all practical honesty, this thing that we're going through, shutdowns and stuff like that, you cannot avoid defaults. Whatever the government is doing today, whether they're paying salaries, whether they're giving liquidity and stuff like that, it's just bringing 100% from 100 companies defaulting down to maybe 50 companies defaulting. It's not going to solve everything. There will still be a huge amount of defaults. Okay. Unlimited QE. Is the ammunition enough to prevent a lower date? Okay. Good question. I think unlimited QE will help because it is actually something which the market likes. Okay, meaning say that pouring in of money and stuff. But I think we have to be very careful because unlimited QE the last time when we had QE1, QE2, QE3, QE4, okay, there was what we call a cycle which was what's it called? What cycle do you call that? A virtuous cycle. Okay, money that came into the system itself depressed interest rates. Therefore, companies could issue bonds at low rates. People had money to pay for the bonds. Company who issued bonds took those bond money, paid off their old bonds, which are of higher interest rate. At the same time, took that money to buy back their own shares. Stock markets then moved higher and higher because of that. And then it was this virtuous cycle which really caused everything, and unlimited QE back then was part of that thing. So unlimited QE today, for it to work, this cycle has to remain intact, which is the big question mark now, given what we're seeing. So again, I'm not saying it can't be the case. I'm just saying maybe it's a bit early for us to tell whether this virtuous cycle is still intact. From the looks of it, there's some cracks to it. So we have to be very careful. Do you foresee Great Depression occur like in 1930s? Let's just, okay, so far the title that we've gotten so far for whatever we've gone through, this is even worse than 2008 and 2009. Those of you who sat through 08 and 09, you know what I mean. We've never seen the world shut down in this kind of manner. Even the data shows, the unemployment rate of now, like in the US was mentioned earlier, 6 million over 10 million, whatever. We've never seen that. Even it surpasses whatever in 08. So easily, this, whatever we're going through today, is now slowly, increasingly being compared to 1930. Okay, it's the Great Depression. Okay, the only problem is we are just still in the early part of the crisis, and we are in a crisis. Let's not kid ourselves, lah. We're in a crisis. We're still just in the early part. How it morphs, whether it morphs into something which is even more worse than 1930, I don't know. I hope not. But I can tell you from the chart I showed you just now, there is a long way down to go because the system has just been so excessive in many aspects, in terms of asset prices, in terms of leveraging, in terms of excessive everything. So that needs to deflate. Of course, central banks, governments today have much more tools than they had in the 1930s. But at the same time, those tools are limited because of the situation. Interest rates are zero. Where do you want to go? Most countries are in debt. How much does government want to actually, Britain got downgraded from, I think, AA to AA minus because of its COVID package. I'm telling you, every country in the world could see their ratings go down because when they launch these kind of packages, unless you're Singapore or unless you're Germany, which has what we call a net creditor nation, a lot of savings, your credit worthiness will come down. Okay. The frightening thing is, I don't know whether we're going to a Great Depression, but the frightening thing is you can't rule that out. And the fact that I'm saying you can't rule that out is already frightening by itself. It means to say that we could get there. It's just that it's a bit early to tell. Okay. There are some market analysts and fund managers suggest to start investing in China funds and even US and Asian high yield funds, which is contra. Yes. What are your comments to why such recommendation is made? Well, I mean, I can tell you that a market is always made up of people who have different views. That's a market. There's a bid and offer. Okay. If you base your views on the past 10 years, buying the dips is what you should be doing. Because every time you brought the dip, it would actually surpass the previous peak. It would decline. Any decline was a massive opportunity to buy. Okay. So if you look at it from that perspective, I would be buying the dip. But there are also a group of strategists, not only myself, who now question that maybe this time is different. Maybe when we look at what's happening, it is not as simple as what happened previously. many a times the declines in market, what we saw over the past 10 years, these were very technical in nature. Markets decline because Federal Reserve suddenly hiked interest rates. Then all the Federal Reserve had to do was actually change their tack and start lowering interest rates. Then market recovered. Many a times market, so all those things were less structural in nature. Today, what we're going through is just mind-boggling. 30 years of being in the markets, I don't know how to answer questions like, revenue is zero for this company. Half the whole country is not going to work. I mean, what are the repercussions of that? I know the immediate repercussions. Of course, companies may have liquidity problems, but I'm not sure the default risk. What does that? How many companies are going to default? How many dominoes are going to fall? How many SMEs are going to be impacted? I mean, so that's the part where I really can't answer, and that keeps me on the cautious side and not to be too gung ho. Okay. What allocation to go? Well, I think in the previous updates, and also I have a video on Go. Please do have a look at that video on Go that I have on YouTube. I also argue that Go's decline basically is technical in nature, margin calls and so on and so forth. If you look at Go in terms of what we call real interest rates, which are going to negative for many countries, including the US. If you look at Go as a safe haven, which I think is still holds that title, okay, you will find that actually Go could easily go back to the 2000 levels, which we saw in the last peak, and even surpass that. Again, take it one step at a time. I think in terms of visibility, I'm happy to say I think Go will go to 2000. I mean, that's my call. So I'm still quite bullish. You should look at the video. I think it explains a lot. Okay, how might the market play out if there is an unlimited QE series of stimulus, relaxed margin calls, ban on short pause selling lists, and how not? Okay, basically what you're saying is how will the market play out if there is unlimited everything? Of course, the market will welcome unlimited everything because central banks will just print as much money as they could. Governments will just give out money to every single person so that they don't they have enough money despite the fact they're not going to work, and so on and so forth. But there is no such thing as a free lunch in the finance world or in any part of whatever we're talking about. There is a cost to it. There's, you can print as much money as you want, but it's going to devalue your dollars, debase your currency. It could be inflationary. Even if it's not inflationary locally, it's going to export inflation. UK, I mentioned, even one COVID package itself has sent your ratings down. Next time you go and issue a bond, you're going to pay more for your bond because people are saying your rating now is a AA-, not a AA. So there are repercussions. So we can actually try and spend as much as we can, but you won't get out of jail scot-free. Someone will have to pay for it. So you're potentially paying the future of growth will be subdued, because once you use up all your money today, and let's say your debt to GDP has gone beyond 100%, you're not going to be able to build your roads, upgrade your schools the next time, because you just spend too much now. I mean, that's a fact of the matter, because otherwise there will be no such thing as recessions, because people just simply print, past 10 years, everybody thought that was the case. Central banks could print their way out of a recession. Governments could actually just do whatever fiscal spending out of a recession and stuff like that. Now, a lot of people are saying now increasingly, this is payback time, because it's caused this huge disallocation, and now we're paying back for what we thought was a Goldilocks period in the past 10 years. Okay. Any last questions? US dollar is strong against most major currencies. How long will it stay? What is the trigger point that could devalue the US dollar? It's a good question. I was asked this, I can't remember where, I was asked either in a radio interview or on a previous update. Okay, you see, what's happening now is the US dollar is a safe haven. a lot of trade in the global economy is still US dollar denominated, oil and stuff. Of course, there's a slight shift away, but many, about 60, I can't remember the exact number, 60, 70%, maybe even up to 80% of international trade and money crossing different borders is paid. One part of it is US, because it's always US against something, US against something. Okay. Because of what has happened over the past month or so, many companies were afraid they have outstanding US dollar payments to make. They needed to pay coupons on their US dollar bonds. Before even anything happened, before they need to even pay, they started to hoard US dollars. Means to say, they started to get hold and keep whatever US dollars they had. And there's a report in Bloomberg, if I'm not wrong, many companies drew down on their credit lines, US dollar credit lines, even though they did not need the US dollars. It was credit line there, but I'm going to draw it down first, because why? I want to keep the US dollars just in case the banks withdraw my credit line further down the road. Why do I want to hoard US dollars? Well, because I got US dollar payment for my shipment. I got US dollar payment for my coupons, bond coupons and stuff like that. Okay, and that actually caused a squeeze in US dollar. So the US dollar started to move higher, and that's why one of the measures that the Federal Reserve came up with was to introduce swap lines with, I think, 7 central banks, if I'm not wrong. What is a swap line? A swap line is, if you're Britain, if you're Malaysia, Bank Negara, you could actually swap your ringgit for dollars. So to ease what we call a dollar shortage in Malaysia or in the UK. Yeah, so these swap lines actually allow for dollars to be given offshore to different countries to help them ease their dollar shortages, so and so on. Why does the Federal Reserve want to do that? Because the Americans know that a high US dollar is not in their interest. There are many instances throughout the past 2 or 3 decades where there have been attempts to cap the US dollar strength, because US dollar strength is actually a squeeze on the economy. So it would actually be very strange if the US administration and central bank allowed a strong US dollar, because one, they are lowering interest rates, okay, which supposedly should be weakening the dollar. Okay, they're lowering interest rates to help the economy. They are introducing trillion-dollar fiscal packages to help the economy, and yet they have the US dollar moving up and offsetting some of this stimulus that both monetary and fiscal are providing. So I won't be surprised if the US Federal Reserve comes out, if the dollar gets too strong. It's of course retraced a little bit recently. If it gets too strong, if they come out and they start to either, they call it jawboning, that means they try and verbally bring it down, or even go and intervene physically in the market to sell dollars. So I won't be surprised. So dollar strength is a technical thing currently. I think dollar weakness could be something on the horizon. Crude oil, which has dropped, currently rarely. Yeah, so the US, the Russia, Saudi Arabia thing is a side story, meaning to say that it can be easily solved, and I think the US has showed that just by saying that I've spoken to both parties are in agreement, you know, the market has rallied. But so that is a technical thing. But the fundamental thing is the more important thing. And fundamentally, the thing now is this. You and I know that it's got to do, oil has got to do a lot with supply and demand. When you look at demand, demand has been decimated. People are not driving to work. No one, SIA, every major airline in the world has almost grounded, if not 100% of their fleet, at least 90% of their fleet. That means they're not flying. And almost every country, people are just staying home, not going to work, not using transportation and stuff like that. You know, well, on the good side, on the good part, the environment has become much more healthier. You know, there's a lot of no more smog and stuff like that, so the air has cleared up. I mean, that's a good part. But so the demand has collapsed for oil. Okay, oil refineries cannot switch off refineries or refining oil with a touch of a button. It's not like any other manufacturing. You just switch off, everybody go back to your homes. Let's close the door. No. Refineries will continue to move despite the fact there's no demand, because it is something which you just cannot stop. I mean, if you understand the whole process, you just cannot stop at a whim's notice. So what happened is the supply continues to grow. And we have now stories of huge demand for tankers because the onshore, on ground, above ground storage for oils are all full. So much so now that refineries have to rent tankers to temporarily park their excessive oil production on these tankers, and these tankers are now parked offshore on the sea next to the wherever refinery, whatever the case is. Okay, so two things will happen. One is now you have a worst case scenario, no demand, high supply. Okay, let's say demand slowly picks up. Okay, and I think going down the road, yes, demand will pick up, but like I mentioned, maybe people will be still afraid to fly, so we won't go back to 100%. We'll still go back to 50% or whatever the case is. So maybe oil price will move away from 20 to maybe 30, 40. But will it go back to 80, 90? Well, until we draw down on that supply, because even if demand goes back to 100%, you are still met with a glut of oil supply because you're still sitting on the tankers. So again, then you need to draw down on that oil supply. Then the demand supply imbalance will come and then you reach an equilibrium. So it does look as though it's going to take a long time. So I won't be very bullish on oil. I'll say that oil probably, some magazines have said equilibrium is at 10 because of this current worst case scenario. But I'll say that maybe it's going to move from 20 now to 30 to maybe 40 and maybe 50. But anything above that, it's going to take longer than that. So I think 40 probably is where oil will go max until we draw down every single drop that's on the supply side that's being kept in stock now. Okay. Yes, I'm Malaysian. I'm very worried about Malaysia because the last budget has oil price about 72, if I'm not wrong, 70 or 72. At current prices, revenues are basically half. So you have a huge gap in the revenue base in Malaysia. But to be fair, many oil exporting countries, if they are not careful, they would be facing the same issue. Meaning to say whatever they budgeted the last year, today they're just getting half of those estimated revenues. So yes, so Malaysia does look like it is in a tight corner. I hope for the best for it. I mean, like I mentioned, I'm Malaysian, but again, it's not only Malaysia, it's everywhere across the world. So to be fair, it's a worldwide problem also. Okay, do we have any other questions? Otherwise, yeah, we almost reached now. I do apologize. I think we started 7:30, about 1.5 hours. Thank you for I still see about 65 people. Thank you very much for staying all the while. I guess it's been a long day, so I'll let everybody go. We'll try and keep updating you on a periodic basis on this. I really hope today's session was useful. Like I mentioned, I didn't repeat a lot of what I've said in the first few updates, which were more relating to markets and stuff. So I do hope you can get from your consultant the recording for the previous sessions, which I think will make a lot of sense and putting all together in terms of formulating a view. Do take advantage of the current situation to relook your portfolios, whether it's the bond side or the equity side. Do contact your consultants. They will be able to also liaise with me to have a look and so on and so forth. Yeah. Otherwise, I thank you very much for staying up. I wish you stay safe. And I hope we get through this particular bad situation as soon as possible. Okay. Thank you very much, and I hope to see you again. Thank you. Oops, sorry, I got one last question. Should we rebalance portfolio according to geographic? Okay, I just want to answer for those of you who are here. Sorry, Chan asked, should we rebalance portfolio according to geographic? Well, you could, Chan. You could. I have also a view that you may also want to look into a different way of doing it. For example, I'll just give you an example. Passive investment has moved out in passive investment has overtaken active investment, i.e. ETFs. Okay, so ETFs itself is basically investing in index stocks. Okay, so one of the reasons why we've seen the index decline tremendously over the past couple of weeks is because when people get out from passive, the end result is index-linked stocks get sold. I take $1 million out of a passive investment, $1 million worth of index-linked stocks get sold. Okay, but the reverse is also true. When the dust settles, okay, when people regain confidence, people are still going to go back to passive. So they will be going back to passive, and then therefore it will be the index-linked stocks which rally. So basically, if you buy into that argument, you could either one search for a sector, whether it's healthcare or IT or finance or what, or you could say, maybe people are going to rush back into passive when the dust settles and everything is fine, when the green light comes on. So maybe I should be buying into funds which deals, or even an ETF, which actually deals with index-linked stocks. Yeah? I mean, that could be another way of looking at it rather than geographical. Okay, so that could be one way. Chandran has, what options do I have if my tenants are moving out of my properties? Wow, Chandran, one thing I mentioned the last time, which I kind of, when people ask me, because during my wealth forums, I kind of sounded a little bit more pessimistic, bearish, and I said you need to really look after your leverage or your current situation. So I said that if you have 4 properties, basically, and if all 4 properties are leveraged and you are renting them out, okay, then you have 2 risks. One is you have a price risk, and one you have a liquidity, i.e. tenancy risk. Because in a crisis, your properties will drop in price. You could get a margin call from the banks, and you find yourself you don't have tenants because it's a crisis. So those are the 2 risks. So I said, maybe what you ought to do, of course now it's difficult, but back then my advice was, if you can sell 1 property and pay up all the 3 because you made profit on 1 property, and you manage to sell 2 properties and fully pay up the 2 properties, then you'll find that you've taken care of your margin call risk because you're no longer levered, you don't have a loan, and you've taken care of your tenancy risk because even if you don't have tenant, then you have no problem because you have no loan to pay. So you just wait it out even with an empty property. It doesn't hurt you because you have no loan to pay. So that would have been the most ideal situation. Of course, now today, if you have a property and you have no tenants, I don't know, it's difficult. I mean, this is a situation which is I can't tell. I mean, it's something which is everybody's facing, whether you are a owner of an office space or an owner of a residential space. If you haven't made the adjustments before this, it's a difficult period now. I don't have an answer to. Sorry, I don't have an answer onto the options. But I can say there is a price to everything. And what do I mean by price to everything? If the market is today at this level, there could still be buyers down there or tenants down there who are willing to pay, but they're not willing to pay at today's level because they look 2 months ahead, they look 3 months ahead, and they say this is going to be a recession, prices are going to come down, I can wait for a little while more. So you can short circuit the whole thing by going into the market and telling yourself, I'm not going to be, I'm going to undercut the market by 20%. Why? Because I rather have someone sitting in my home paying 20% less than to leave this thing empty and not knowing when I'm going to get a new tenant. So you bite the bullet, sit with a rental which is 20% of or 30% of what you would have gotten, you would like to have gotten, but at least you get some cash flow coming in. Yeah, I mean, that would be my best answer. Okay, I think we've crossed 9. I hope I've answered everything. If you have any outstanding questions, please do approach your consultants. They will forward the questions to me, and I hope to get back to you. Okay, I wish you all again stay safe, and I'll get back to you, and we'll hopefully meet up again another time. Okay, thank you very much.